Nobody tells you that investing is an emotional journey before it's a financial one. When you have $500, you're terrified of losing it. When you have $50,000, you're second-guessing every move. When you have $500,000, you're worried about protecting what you built. And when you finally cross $1 million, you realize the money is no longer your biggest problem. Today we're going to walk through every real stage of wealth. What's actually happening in your account, and more importantly, what's happening in your head. Because the psychology of investing changes completely depending on where you are. And if you don't understand that shift, you'll always feel like you're doing something wrong. Let's start from zero, stage 1, $0 to $5,000. The fear stage. You open a brokerage account. Maybe it's Zerodha, Robinhood, or your local bank's investment portal. You deposit $500. And then you just stare at it. You're scared to buy anything because every stock feels like gambling. You watch it go up $3 and feel relieved. It drops $8 and your stomach drops with it. You check the app 14 times a day. This is normal. This is not stupidity. This is your brain doing exactly what it evolved to do, protecting a resource that feels critical to your survival. Here's the financial reality at this stage. Your investment returns are almost mathematically irrelevant. If you earn 10% on $500, that's $50. But if you save an extra $200 this month, that's $200. Your savings rate is your superpower right now, not your stock picks. What actually works here? Index funds. A simple S&P 500 or total market ETF. You buy it, you automate a monthly contribution, and you stop watching it daily. The Vanguard VTI, iShares MSCI World, or Nifty 50 Index, depending on your country. They're boring, they're diversified, and that's exactly the point. The enemy at this stage is not the market. It's the urge to do something clever. Stage 2, $5,000 to $25,000. The curiosity stage. Something shifts around the $5,000 mark. The fear doesn't disappear, but curiosity starts competing with it. You've survived a market dip. You watched your portfolio drop 15% and you didn't sell, and then it came back. That changes you. This is also the most dangerous stage, because now you feel like you know something. You start researching individual stocks. You find a company you believe in. You put 30% of your portfolio into it because it just makes sense. And maybe it works, which is actually the worst thing that can happen, because now you think skill was involved. Here's what the data actually says. Over any 15-year period, roughly 85 to 90% of actively managed funds fail to beat their benchmark index. Individual retail investors underperform by an even wider margin on average, largely due to buying high and selling low. The right move at this stage is to keep your core, 80% of your portfolio, in index funds, and if you want to scratch the stock picking itch, cap individual stock positions at 5% each with a hard ceiling of 20% in individual names total. This is sometimes called a core and satellite approach. You're building a habit. You're building a process. That's more valuable than any single trade. Stage 3, $25,000 to $100,000. The slow grind stage. This is the hardest stretch emotionally. Not because anything is going wrong, but because nothing feels like it's going fast enough. You've been disciplined. You've contributed every month. You're doing everything right. And your portfolio just slowly climbs. You made $4,000 last year in returns. Your friend told you he made $18,000 flipping a condo. Your coworker's crypto trade went 3x. This is where most people abandon a sound strategy. They see someone else's highlight reel and mistake it for a repeatable system. Let's talk about what's actually happening at this stage mathematically. At $50,000 with a 10% return, you're making $5,000 per year just from growth, without doing anything. That's more than most people save in 6 months. The compounding is working. It just doesn't feel like it yet. This stage is also when asset allocation actually starts matching. You should be thinking about whether your 100% equity portfolio is right for you, or whether some allocation to bonds makes sense given your timeline. A 25-year-old can tolerate 90 to 100% equities. A 45-year-old might want 70 to 80% equities and 20 to 30% in bonds or other assets. The emotion you need to fight here is impatience. The system is working. The scoreboard just updates slowly. Stage 4, $100,000 to $500,000. The turning point. Crossing $100,000 is the first real psychological inflection point in investing. Why? Because at this level, the market starts doing more work than you do. If you're contributing $1,000 a month, which is $12,000 a year, but your portfolio earns 10% on $150,000, the market is contributing $15,000. Your savings are now the smaller number. That is a profound psychological shift, and it changes how you should think about risk. This is also the stage where tax strategy becomes genuinely important. At $50,000, it barely matters. At $300,000, it can mean tens of thousands of dollars over a decade. Things like tax loss harvesting, selling a losing position to offset gains elsewhere, or moving assets to tax-advantaged accounts, like your 401k, Roth IRA, PPF, or NPS, depending on your country. These moves have real mathematical weight now. Another shift at this stage, people start thinking about real estate. And here's the honest answer. Real estate isn't better than stocks, and stocks aren't better than real estate. They behave differently. Real estate gives you leverage, cash flow, and a physical asset. Stocks give you liquidity, diversification, and lower friction. Both belong in a serious portfolio. The mistake is thinking you have to choose. The emotional trap here is lifestyle inflation. When your net worth crosses six figures, spending feels more justified. The car upgrade, the bigger apartment, each one feels reasonable in isolation. Together, they can quietly destroy your compounding curve. Stage 5, $520 to $6, $2,500,000 to $1 million. The anxiety stage. You'd think having $500,000 would feel like freedom. And for a moment, it does. Then the fear changes shape. It's no longer, I'm scared I won't have enough. It becomes, I'm terrified of losing what I've built. These feel similar, but they produce opposite behaviors. The fear of not having enough makes you invest aggressively. The fear of losing what you have makes you go too conservative, too early. And that is one of the most costly mistakes in personal finance. Here's a real scenario. Someone has $750,000 at age 52. Panicking about a market correction, they move 60% to cash. Over the next 5 years, the market returns 12% annually. That cash position cost them roughly $200,000 in unrealized gains. Not because they were stupid, because they were human. At this stage, you need to separate your portfolio into mental buckets, not just for psychological comfort, but because the strategy genuinely changes. Money you'll need in the next 2 to 3 years should be in cash or short-term bonds. Money for years 3 to 10 can be in a balanced fund. Money you won't touch for 10+ years stays aggressively invested. This is sometimes called a liability matching strategy, and it's what financial advisors actually use. This is also the stage where a fee-only fiduciary financial advisor is worth considering. Not someone who earns commissions on products they sell you. A flat fee or hourly advisor who is legally required to act in your interest. That distinction matters enormously. Stage 6, $620 to $721 million plus. The identity stage. Nobody prepares you for what crossing $1 million actually feels like. It doesn't feel like arriving. It feels like being responsible for something fragile. The goal that drove you for years is gone, and suddenly you realize you never thought clearly about what comes after the number. At this level, investing becomes less about growth and more about structure. $1 million portfolio earning 4%, which is the classic safe withdrawal rate used in retirement planning, generates $40,000 per year. That's real. That's livable in many parts of the world. The math of financial independence is no longer theoretical. But here's what happens emotionally. Many people at this stage work harder, not less. The money stops being the goal and becomes a score. They compare themselves to people with 5 million. The hedonic treadmill just moved. It didn't stop. The actual strategic questions at this level are about withdrawal sequencing. Which accounts do you draw from first to minimize lifetime taxes? About estate planning, beneficiary designations, and whether a trust structure makes sense for your situation. About how to gift money to family without creating dependence or resentment. And perhaps most importantly, what was the money actually for? People who answer that question clearly before they get here tend to be far happier than those who assume the money will answer it for them. What every stage has in common. Here's the thing that unites all of these stages, and it's the thing nobody says clearly enough. At every level, the biggest risk is not the market. It's you. The fear at $500 that stops you from starting. The overconfidence at $20,000 that blows up your portfolio. The impatience at $75,000 that makes you abandon a strategy that was working. The panic at $700,000 that locks in permanent losses. The identity confusion at $1 million that makes wealth feel hollow. The market will do what the market does. It will crash. It will recover. It has done that 12 times since 1950 in the US alone. And every single time, the people who stayed invested came out ahead of those who tried to time it. What actually separates people who build wealth from people who don't is not intelligence, not income, not even luck. It's behavioral consistency over long periods of time. Automate your contributions. Diversify broadly. Keep your costs low. Rebalance once a year. Don't touch it. That advice works at $500. It still works at $5 million. It is boring on purpose. Boring works. The journey from zero to financial freedom is mostly about learning to feel less when the market moves, not more. And that skill, ironically, is worth far more than any stock tip. If this helped you, share it with someone who's just getting started. And if you're already deep in the journey, tell me in the comments which stage hit closest to home.